Hey everybody, welcome to another episode of Stock Talk here on Periscope. My name is Amin Rana. I'm an investment coach here at Sage Investors, and this is episode 42. Today's episode is really set up to be a bit of a rant. A couple of weeks ago, about 3 or 4 weeks ago, I read this article in the Globe and Mail talking about robo-advisors and how you go about picking a robo-advisor. And I read this article and I was totally pissed. After I read it, I couldn't believe what I was reading, and I was just ready to just jump on here and just go and just slam this article royally. But instead, I decided to go to Iceland for a week. And so I went, I sat in the Blue Lagoon for a while, I drove on the Golden Circle, I went down the South Shore, saw some nice volcanoes, saw some geysers, and I came back and I decided to read the article again, and yeah, I was still pissed. But not as pissed as probably as I was when I originally read this article. So I just wanted to share with you, and so it's a little bit of a rant, and I really have some issues with one of the key themes it's trying to project, and it's something I have a bit of an issue with respect to robo-advisors, how they're being covered by the media, and how people are looking at these things. And so that's pretty much what I'm going to talk about today. So the article I'm talking about here is called How to Pick the Right Robo-Advisor. It's on the Globe and Mail. I'm not going to tell you who the author is. You can probably Google the article, and I'm not even going to just put it like, there it is. I'm not even going to give credence to the person who wrote this thing. It's just really all about the article and the thoughts and the words and all that stuff, because I don't want to go there for that. So here's how it starts off. So, quote, robo-advisors are for people who want a sound, smart investing solution, not home runs. So, and then goes on. So stop asking me if I'm tracking the performance of the portfolios that robo-advisors use for clients. I'm not. What I follow is the methodology and the building materials they use for constructing portfolios. If a robo gets this right, solid returns will follow. After I read this, I went crazy. You're telling me that performance doesn't mean anything? The first thing I think about is, why do we invest? Like, why do we put money into stocks? Why do we put money into bonds or GICs or real estate or art? Why do we invest? It's cardinal rule. Why do we invest? Anybody? We invest to make money. Ultimately, we're in this gig. We're spending all this time, we're hiring advisors, we're hiring robo-advisors. We want to make money because we have goals, we have requirements and things we want to accomplish later on in our life that are going to cost money, and so we need money. And so ultimately, that's why we're investing. We're not investing to prop up a back office. We're not investing out of civic or patriotic duty to some organization, an entity, a country. We invest to make money. And at the end of the day, as an investor, performance should be right at the top of understanding whether the investments that you're undertaking are working for you. So the question is, if according to this article, if performance isn't such a big deal, then why do we care about it when we talk about individual stocks, or if like a stock is going down 20%, or why do we care about things like dividend yields and other performance type metrics? Those seem to be, we pay a lot of attention to it in the media and in day-to-day investing, which we should, but when it comes to robo-advisors, apparently they get a free pass. Like, it doesn't even matter if they're making any money or anything. It's moot. It's irrelevant. So to me, that whole premise, and I just find it fascinating that a lot of commentary that I see in media and in blogs, financial blogs out there, they talk everything about, they glow and go gaga over this business model, but there's no performance, there's no track record. It's literally a black box right now. And to do that, to make these kind of observations without even looking at the fact that what does it deliver on performance, doesn't make sense. So to me, it just blows my mind how little credence or how little chatter is out there with respect to how these things perform. Now, the article then goes on to give a few reasons why it doesn't really care about performance, and it cites some reasons. And when you think about it, I kind of get it, but let's just go through it. So the first reason, I guess, why this person here doesn't really care about performance is, one reason is that, quote, robos have been around for 1 to 2 years at most, and any returns posted over that short time frame would be borderline meaningless. And yeah, that makes sense. Like, there's a short sample size. the thing is, and it's interesting because in this article he's saying, I've just started the job of gathering data for the second annual guide to online advisors. And it's like, okay, they're preparing this guide to online advisors to tell people which advisors are great, but they don't talk about performance because they're saying there's not enough data. So if that's the case, why are you creating an online advisor guide? It's just a black box right now. It's such a new business model that there isn't much of a track record. Most of these companies don't have track records. It's ironically interesting that we've just, in Canada, we've just come up with new regulations called CRM2, which force mutual fund companies and financial advisors to disclose fees more on a line-by-line basis and to be much more transparent in terms of performance. But I guess when it comes to robo-advisors, well, sorry, it doesn't really seem to matter. And again, that doesn't make any sense. It's just right now, it just seems like the market, the media, there's a lot of buzz, especially going after the millennial market with respect to robo-advisors. They're just crazy on them right now. But the reality is there's not much of a track record behind them. So it's kind of hard to want to put your hard-earned money into something that's really pretty much a black box, and you can't see what kind of history there is behind it. So that's one reason that it goes. So I get it. There's not enough sample size on it. Probably meaningfully, you need about 5 years really of performance data to really get an assessment of it. So personally, I'm not pronouncing judgment on these things because, as I said, it's early days on it. But what I'm doing is I'm actually trying to address this whole concept of performance in a small, minute, micro way, because I've actually set up an account with a robo-advisor and I've been actually blogging about my personal experience with a robo-advisor and also the performance of that robo-advisor. And if you follow my website, you can actually see all my blogs and postings and my observations about the whole business model and the whole model and my whole experience on it. So that's one thing. So the second reason, going into the article, back to the article again, sorry about that. The second reason why performance doesn't seem to be a big deal with respect to robo-advisors is, quote, second reason for ignoring return flows is out of the fact that robo-advisors are about process, not about picking winning investments. Now, process is important. I'm not going to say I'm going to dismiss process. Yeah, bottom line is you want to make money. But as I said, I work as an investment coach. I teach people how to invest, and one of the things I teach people is to learn and develop a bit of a framework and a process for how you go about making investment decisions, for how you go about buying and selling stocks. But it's a process, and everybody has a methodology and an ideology of how to do it. And just because I teach people out of it doesn't mean I'm saying my process is better than anybody else's. I've seen some totally different, totally way out there type process that are very legitimate out there. But at the end of the day, why do we invest? We invest to make money. And when you're going to go pay for your kids' tuition, the university isn't going to care about the process you go about, coming up with the money for the tuition. They just care about how much money you have. When you go pay for your groceries, the grocery store isn't going to care about the process you use to buy emerging market stocks. They're going to care about, do you have the money to pay for this? So at the end of the day, investing is about making good decisions. And ultimately, if I'm going to outsource my decision making to other companies, to other people and professionals who are claim to be better at it, I need to see that they have demonstrated a competency and a track record for making good investment decisions. So at the end of the day, process is important, but I need to see that they've demonstrated the competence. I need to see the results. Now, finally, the last reason they talk about, and this is a bit of a reality check, and I kind of again agree with them a little bit here, is let's be realistic about return expectations with robo-advisors. You will never crush the market and lead the performance charts if you track major indexes, which is what robo-advisors do. What you will do is you'll make what the markets make, minus some fees charged by the robo-advisor in your ETF, and at the end, you're not going to do any better than anybody else, and you're going to be a leader. You're not going to be much of a leader. And it makes sense. That's realistic. But the fact is, the person writing this article is just basically telling us this is what the impact is going to be. But he's just gone, or she's just gone through explaining, well, we don't have enough data to prove that this is going to work, and we don't know what the results are. But somehow he's telling us, yeah, this is what's going to happen, by the way, if you go invest with a robo-advisor. So I found it a bit contradictory, and a little bit little bit out there in terms of that side. And then finally, it goes into some like basic factors that you need to go into picking a robo-advisor, which I get. You know, you talk about, you know, standard boilerplate approach evaluation methods like fees, you know, low fees, does it ability to rebalance, types of ETFs, types of asset classes, you know, standard kind of stuff there. So, you know, again, the gist of this article is just talking about how performance is not a big deal, and I just totally disagree with that. It's all about performance when it comes to investing, and I just got really pissed when I read this type of article here talking about that thing. It's not, and I think it is. It's to always be front of mind, top of mind when you're making investment decisions. Either you're making just investment decisions by yourself, on your own, as a do-it-yourself investor, or if you're outsourcing it to an advisor, to a bank or a brokerage. Performance is always top of mind, and that's all. I just want to constantly reinforce that, and I reinforce that with the people that I work with. So, I feel much better now. I think I've cleansed myself. I think I've had a lot of built up frustration here and anger, but I feel cleansed. I feel cleansed now. I had an opportunity to share with you, to let it all out, and I feel like a much better person about it. So that's all I got for you. If you want to follow a little bit more, as I said, of my observations on robo-advisors, my personal experiences with robo-advisors, you can go to my website, www.sageinvestors.ca. If you want to follow any other market observations that I capture, pique my curiosity, you can follow me through Twitter. My handle is @SageInvestors. So that's another edition of Stock Talk. My name is Amin Reina of Sage Investors, and we'll catch you again another time. Cheers.